Devina, at the outset, Indonesia notwithstanding, India and maybe a couple of other countries notwithstanding, India has been a relatively better performer for better part of 2022. If indeed you believe that the narrative of Fed hikes has peaked, do you reckon there is a probability that India could underperform, as some of the underperforming markets might actually now start outperforming?
For over a year, I have been saying that India will be an outperformer. So even the beginning of this year, I had said very, very clearly that I see India continuing to be an outperformer this year. And the reason for that was that there was a very long period, a whole decade, practically from 2010 to 2020, when India was an underperformer, both relative to global markets as well as relative to its own history. So let me just give you a little bit of background on both these things. So if you look at that whole decade from 2010 to 2020, Indian equities compounded only about 8.5% or so. And if you remember, at that time, the fixed deposit rates used to be 8%. So, the equities practically gave you no extra return for all the volatility and risk. So that impression which we have that Indian equities compound 15-16%, that starts from when the Sensex started in 1979 base year. So it has compounded that. But decade to decade, the variations have been very, very high. So the first decade was like a 21% compounding, and this decade was like 8.5%. So after that COVID lows, once it started going up, I was quite clear that it is very far below the trend line still. So the risk of a crash comes when you are above the trend line. Right. So even after all this performance, you are not at the trend line still. So that risk didn't appear very material. If you look globally, there are about 42 country indices that are of significance. So if you look at that decade, again, India would be number 24 one year, number 21 another year, number 25. So basically in the underperforming bucket. So 2021 was the very first year that we came in the outperforming category. So I was quite clear that once that trend had changed, it would continue for a while. So that has happened. As the end of 9 months of the year, in those 42, we were number 8. We were still negative in dollar terms, but we were number 8. And the ones above us were mostly the commodity markets, Saudi Arabia, UAE, Brazil, Chile. Turkey was number 1, but then Turkey was number 42 last year. So strangely enough, last year Turkey was 42, it became number 1, and Sri Lanka was exactly the reverse. It was number 1 last year and 42 this year. Wow. So that was the background as far as India is concerned. If you look at otherwise geographies and asset classes, this has been a very strange year, a very outlier year, you can say. So again, at the end of 9 months, when we looked at the end of September, so if you look at S&P 500, for instance, it was negative in every quarter in the first 3 quarters this year. Now, how unusual is that? In 50 years, that was only the 4th time it had happened. And then if you looked at US, because that's the largest market, the equities and bonds, they were both significantly negative for the 9 months. That was only the 3rd time in 100 years, which included the Great Depression. So it was that much of an outlier. When we looked at all asset classes, everything was in the red. The only exception of not just general commodities, but only essentially oil and gas. Everything else was a sea of red. There was no place to hide if you were a long only fund. So that was how strange this year was in terms of being an outlier. So then again, you say that, is it all going to zero, or now what is the probability that things will look better? And so that is why at the end of September, we said that now the probability is high that global asset markets would do better, especially equities. There was still some uncertainty on Europe, though Europe actually has rallied since then. But everything else, at one point, NASDAQ was number 40 out of 42, and then even end of September, I think it was number 35. So that is a strange thing in markets, that last year when Nasdaq was booming and you had all these Nasdaq ETFs and funds being launched even in the Indian market, I used to say that don't think that the Nasdaq is a no-brainer, because that can also not do well. But at that time, no one was willing to listen. When it went down 40%, then everybody wanted to head for the exit, saying now it is too risky, which was the second wrong decision if you decided that. So that is the other thing which I'm writing an article on this, that if you look at all the academic studies, sentiment is a contraindicator of future returns. So when sentiment is very poor, when everybody is scared, things are very risky, the next period returns are above average. And when everybody is very happy and piling on, the next period returns are below average. So that was another indicator. The third thing, if you look at just on a longer term step back basis, this is an analysis that I had done in June. I had, in fact, been on several TV programs. I even did a webinar on this, that if you look at, this was, again, I mean, the data, if you go into, brings up so many interesting things. So we knew this 15-16% long-term compounding of the Indian market. So if you had invested 100 rupees in 1979, that would have become 44,000. That was the number. He said, like, suppose you missed out on 10 good days. This is 40 plus years, and 10 good days doesn't seem like a lot of days in 40 years. What happens? And but the thing is that if you miss out on just the 10 best days of the market, that 44,000 comes down to 15,000. So 2/3 of your returns gone in 10 days. If you miss out on 30 good days, which is less than an average of 1 day a year, your return comes down to less than 4,000. Essentially, 90% of your return just disappears. So that is the skew. And the other thing which we saw was that these good days come in when, again, sentiment is poor, usually after a fall. So in June, I had said very, very clearly that now the risk really is in not being invested rather than being invested. Because if you're not invested, you can miss out on a big up move. And I later on checked that day that when I said it, I mean, I said, I don't know whether this is the bottom, but it is somewhere there. And that day, the Nifty was 15,293. So, in 2 months, you've got a 18% move. So that is the thing, oftentimes people just keep, and yet, I mean, we went and told all our clients that this is the time to get in, but very few actually did. I mean, people just keep sitting on the fence that we'll do it once the dust settles, when things are clearer, but that is always a bad strategy. If you go to COVID time also, COVID, the March 2020, beginning of March, we said, again, this is on a public platform, that I said this is something very unprecedented happening, because that time Italy and Japan had shut schools, and you had all these visuals of the Rome's tourist attractions with nobody there. I mean, later on we got used to those visuals, but that was the first time I saw something like this. And I said, this I have never seen. I mean, even during the World War, nothing like this happened. So we totally moved out of equity in our multi-asset products. We moved into cash, we bought insurance. So when the fall came, we fell very little. So 35-40% for most funds. Between our global and Indian products, the range was, I think, 8 to 11%.
Sure.
But then on March 23rd, again, we said publicly that now it is time to get back in. So when people say that, tell us when to get out and get in, I said, even if I tell you, will you be able to do it? If I told you on March to get out and March 23rd get in, would you have done it? I mean, we as a fund manager can do that. But because if you missed out on that from that March 23rd to April end, which is a period of roughly 5 weeks, both India and US were up 28 to 30%. So if you miss out that move, again, you can't make it up. So, I mean, ideally, what you should be able to do is that if you can sidestep the crashes, either through insurance or otherwise, and then be there when these rallies come or the up move days come, that is the holy grail. That is what you aspire to. But very difficult for people to get over that whole mental blocks and
of course
being scared and all that. So that is the thing.
Yeah, but so in which case, Devina, are you buying insurance right now, or are you constructive on India?
No, I still think India is still looking fine, and the outperformance will continue. In our global funds, we would be overweight India. So, and you mentioned Indonesia. Yes, Indonesia also looks good. A couple of other markets like Mexico, Canada. US itself, we like non-tech more than tech. So now our systems are liking more traditional cash flow businesses like consumer staples and so on. So in the US will tend to be overweight that, because also, I mean, even if you look fundamentally, that the rate tightening cycle hits the companies where the cash flows and profits are far away, because that discount rate is going up essentially for a cash flow, discounted cash flow. So
So am I to
that
understand, Devina, that you're not exactly buying value currently? I mean, you buying growth, so to say, right? India has done well, it's growing, you're buying that. Indonesia, same thing. And in US, if you're not buying tech, which means you're not buying the beaten down names, you're actually buying something else.
No, I mean, see, US, we buying some beaten down names, but I mean, if you talk of value, then I mean, I would say that, as I said, that our systems are liking companies with more cash flow currently. So, which you can say is the value bucket. So, I mean, we would be more overweight that. So, when I say non-tech, more cash flow, so that is that is what it is. I mean, in tech, you can argue. I'm not saying that you should not be buying, but a lot of stocks which have fallen still don't have great cash flow to even justify this valuation on traditional metrics. So, I mean, you might still like that, but I mean, not everything is, I mean, like Meta, of course, you will say that has profits and cash flows, but many of the smaller names don't. So you have to really pick and choose. Um, so that is the thing. In India, of course, yeah, India valuations are high, as they always are relative to the rest of the world. I don't think India has ever been cheap relative to the world. But India, of course, while I had said this beginning of this year also that the market would outperform, I had also said that it is not the market of 2021 when a rising tide sort of lifted all boats. This year you have to be more pick and choose in terms of sectors and companies. So that still remains.
I was about to ask you, that continues, right?
That continues, and especially, you know, this year the commodity prices have been all over the place, so that has impacted different companies differently. In some cases the output prices have gone up, so very good for the profits and margins, whereas for others inputs have gone up, and so it has actually pressured the margins, though of course now a lot of commodities have retraced that big move they had.
Yeah. Does it tempt you, Devina, to therefore try and fish in that pond of companies which will benefit from margin stabilization or a recovery? A bunch of companies have kind of said in the con calls that it'll likely happen Q4 onwards. Do you kind of feel like fishing in that pond?
It depends. I mean, now, as I said, you know, it is difficult in many even sectors in India to say that buy this sector. You know, like for example, chemicals is a good example, because that has companies in both categories where, you know, margins have been under pressure and where it has been boom time because their finished goods prices have gone up. So it has to be pretty granular. I mean, I can't say as a blanket thing that only sector as a whole, which actually we have been overweight for a year now, more than a year, from October last year, which is capital goods and industrial machinery. So that was a bet we made last year, and that still continues. So in terms of, you know, overweight relative to the index, that would be probably the highest, uh, because that came out of a 10-12 years of being an absolutely dog sector, and then, you know, the fundamentals changed, and so that was a good bet. But otherwise, I mean, most things have not been very sectoral. It has still to be, you have to drill down within the sector. One sector which as a sector is looking better than what it used to has been banks. I'm normally not very fond of banks because I think it's a highly risky sector, highly leveraged, and prone to negative surprises which you can't see sitting outside. But on a fundamental cycle, it's in a good place. Plus, it is coming again out of a long period of underperformance. In 2020, I mean, banking was the only sector that was in the negative. In 2021, it was not in the negative, but it went up only half as much as the market. So from there now, I mean, we're still probably not overweight, but would now be about market weight on banking.
Interesting. Actually, on that note, Devina, a bunch of reasonably smart investors are also constructive on PSU banks. And that space has come out of nowhere from October lows, 39-40% rally. It's caught a large bit of the market by surprise. Any thoughts there? PSU banks?
Yeah, I mean, the PSU banks are looking good. I mean, that's so in banking that has been a segment that's been looking good. So I mean, you can also look at the fundamental side that the NPA cycle is behind you, credit growth has been good, and also when interest rates go up in the beginning, it is good for the margins because your assets, which is the loans, get repriced immediately. The interest rate goes up, but on the deposit, it goes up slowly as the deposits are rolled over. So it is positive for the margins, except for the bond portfolio, which is a different thing. So that is why. So you can say that fundamentally also things are looking better than they have for the last few years.
May I slip in a question around themes which are just being dogs, if not for the last 3 months, then in certain cases even for a slightly longer period of time. I mean, take case in point pharma, case in point insurance, which never mind the last 2 days of a rally, but for 3 years on a trot now, insurance has hardly done anything right. I mean, how do you look at these themes?
We are still not very positive on these. You know, pharma was okay as a defensive when the market was not doing so well for a few months in the middle after that rally. But otherwise, it is not generally a sector we still like. I mean, that is still probably closer to the bottom of our list as a sector than higher up. I don't think insurance also we would have exposure just now.
No, okay, got it. Devina, before I again turn back the clock on macro a little bit, just a couple of micro questions. One of them is on the tech and not IT services. Maybe you're constructing. I mean, okay, great to get your view on IT services too. But beyond that, the tech businesses, be it fintech, consumer tech, what have you, there are 5 or 6 or 7 or maybe 10 odd listed names out there. How from their glory day valuations, still expensive to some people, cash flows might remain a concern as well. What are your thoughts? It's a very widely discussed bucket, especially in light of the fact that supply has suddenly increased because of the lock-ins getting over.
Yeah, so last year when the IPOs were coming in, my view was very clear that there's a whole lot of concerns, including, of course, as you said, profits and cash flows being far away. The other thing is that when all these companies go into an IPO and then later on are listed, there is a different pressure to show either some profits or at least lower losses. So most of them cut down on what they can cut down, which is usually discretionary marketing spend. So going into the IPO itself, if you see, there's generally a market share loss. So whether it is Paytm, whether it was Zomato, I think even Policy Bazaar, everybody had a market share loss. Then, of course, people who are using 20, 35 and 20, 40 profits and cash flows to justify the valuations, which is absurd. And you come up with all sorts of valuation metrics. And I always say that when you are coming up with innovative valuation metrics, you're not looking to value a company, you're looking to justify a valuation.
Yeah.
There is only one way to value a company. And while you're saying these are tech, but I mean, almost all of them, the entry barrier is not tech. They are not really tech companies. There's no tech entry barrier. They are mostly either D2C, that is direct to consumer companies like Nykaa is, or are platforms. So there is really no entry barrier other than that brand building, which essentially means spending money. So this is the other thing that, when you are the first mover in an industry, you can build that business. But if you if you've proven that this is a valuable business, other people will also come in.
Yeah.
So that is the other thing. I remember long back when Hindustan Lever was entering atta. I had spent a couple of days in Anand with Amul just to understand their business, and I was asking them, the Lever is going into atta. What do you think? And they said that we don't think it's a lucrative market that will give margins. But if levers proves otherwise, we will enter. what what is the big deal? so so that is how it works in these businesses. And also there was the example of all those listings in the US, whether it was Uber, Lyft, DoorDash, etc., and none of them had done well post IPO. So that was the background. I mean, obviously now valuations have fallen, but I mean, how do you even justify these valuations? I remember last year when these IPOs were on, in one of the TV shows, the anchor said that I will put a gun to your head, which one will you buy? And I said, even a gun to my head, I will not buy any at these valuations.
I'll not buy, I'll die.
So, so this is not this is not a segment that gives a great deal of comfort. Of course, at some point you can buy and get a bounce. That's a different thing, but that's not the business that we are in. Because we are first, as we say always, first focus is risk management, and the second is return management. So that is the way we do things, because as I say, investing is a loser's game. So for your viewers, loser's game is a old article, I think 1970s, written by Charles Ellis. I mean, worth reading, on how everything in life is a winner's game or a loser's game, and how it changes. So investing is very much a loser's game. So first of all, you have to ensure that you don't lose, that you remain in the game. There are no big drawdowns. I mean, just to give you context, for example, the day the Russia-Ukraine war broke, the market fell 5%. Our portfolios fell 1.6. So that is what I mean by having a more resilient portfolio where you don't see great drawdowns.
Yeah, because you would have seen a bunch of data thrown in there. I remember a conversation with Devina earlier when I mentioned that people say that in God we trust, everyone else must bring data. And Devina said, we tell that even God must bring data. My final question.
All the calls that we make really are on data. So even that Russia-Ukraine war day, that very day, I don't think anybody else would have dared do that. I made a video saying that 6 months later, it will not show up on stock market charts.
Oh,
because I looked at data going back 40, 45 years of every geopolitical conflict, from the two Gulf Wars, Afghanistan, US bombing Libya, 9/11, and not on an average, but every single case, there was no impact visible a year later in markets which were not directly impacted. So I said, other than the fact that this will have an impact on commodity prices, which you will need to track, but directly the fact that this war is on will not impact stock markets. They'll forget it sooner than I mean, all these conflicts, the markets react just before and just after, but then it sort of dissipates.
Got it. My final question, Devina, and like I said, I want to end with a macro. The refrain that people who are negative, and they may be right also, I'm no one to decide who's right and wrong, but I'm just asking, they refrain from people who are not so constructive on markets currently, is that if the US enters a recessionary phase, and if the US markets were to go off, then the other markets will follow suit, and India, which is expensive, certainly has room to correct. What would your assessment be about what could happen if indeed the US markets were to go into a bit of a tailspin, say in the first quarter or the first half of 2023?
Okay, so first thing is that the economy and markets are two different things. So if you look at the US, do I think it going into a recession? Yes. I mean, that is again fairly unambiguous, and especially this last signal when the 3-month yields, 3-month interest rates went up above the 10-year interest rates a few weeks ago. And that signal has never failed in the past. It's never happened that particular inversion in the yield curve happens and there is no recession. So that is there. But the point is how much of it is already in the price, which is why I gave you that background of that 9 months, whether it was the S&P or the S&P as well as the bonds, it has been a historically outlier year. So my bet was not that that US was not going to a recession, but it was already discounted in the price. So I mean that disconnect remains. If you look at China, for instance, Chinese market is roughly half of its 2007 highs. 2007 highs. The Chinese GDP is up 6.5 times since then. So it can be that kind of a disconnect. So it is not linear that US is going into a recession, therefore the US market is also going down. I mean, that has already been discounted in my view. That so that is my base case, that it is not, the US markets are not looking so bad. US economy might not have hit its trough yet.
Okay. Well, on that positive note, if I may, thank you so much, Devina, for joining us today and giving us all your insights. Lovely having you.